I'm Scott Fox, and I'm here to tell you today why I don't think you need venture capital. The world has changed, and if you have dreams of online success, you want to start a website business, you have your .com name all picked out and a business model ready, oftentimes people think that the next step is to step out and go find some venture capitalists to give them money. I think that's wrong. I don't think you need venture capital, and I want to stop you from wasting your time doing that. Why? Why would I say that? Well, there's two reasons. One is that today, you don't really need venture capital. Unless you have an idea that it requires massive amounts of engineering talent and infrastructure. Most website ideas can be started online fairly inexpensively. And you would probably want to do what they call a proof of concept or a beta test using a simple off-the-shelf system like WordPress or a Yahoo store, and tying together a couple of those pieces to create a prototype that proves your point before you raise money from somebody else and give away a chunk of your company. Doing it cheaply is more efficient and more effective. That's the whole thesis behind my first book, actually, which is this one, called Internet Riches. I think that you don't need venture capital because the world has changed enough that you can rent multi-million-dollar software packages, often for $10 or $20 a month. If you tie all that horsepower together in clever ways and prove the concept using inexpensive services like that, and maybe some marketing on Facebook and some pay-per-click ads and some off-the-shelf stores or blog software, you can demonstrate a lot that will be a lot more impressive to any investor without raising money. And second, I want you to ditch the business plan idea because you can spend so much time pitching for money that you forget to build the business. And I know this from personal experience. My first company, my main product was business plans. I wrote a business plan over and over and over again, each time raising a little bit more money, but never actually raising enough money to really get the product out there. And that was my mistake. I should have focused on building the product and proving its worthwhile nature by selling it to a few people. Having revenues is the best example and the best way to raise money. But further than that, I don't think you need the money anyway. I ran across this study the other day, and that's why I wanted to talk about this today. The vast majority of startups don't receive any VC funding anyway. The idea of venture capitalists only entered the popular imagination maybe 10 years ago with the dot-com boom. Everybody suddenly thought, I have an idea, I find this mysterious creature called a venture capitalist, and he'll write me a check. And then I'll have a couple $1,000,000, and I'll start a company, and I'll be rich, I'll go public. And that actually kind of worked for a few years, believe it or not. And today we're almost back to that, at least in certain sectors of the technology and web-based business industries. But I don't think that's where you need to be. I think you need to focus not on venture capitalists or even on angel funding. Angels are what they call your friends, your family, your great uncle's golf partner, somebody like that who's going to write you a check, who's not necessarily a professional investor, but they buy your idea, and most of all, they're probably investing in you. They like you, they like your idea, they want to help. Those folks also, well, they're going to take a chunk of your company. Unless your idea is so good that you're going to quit your job and become a professional fundraiser, I wouldn't even go down that road. I would spend your time in your off hours building your concepts as much as you can until you have working prototypes that really prove your point, and most of all, have some customers. Now, the study that I'm quoting here, this actually came across the TechCrunch blog a few days ago, and this is an excellent post by Vivek Wadhwa, and he is a visiting scholar at UC Berkeley, also associated with Harvard Law and Duke University. Really smart guy. I love his posts. Vivek Wadhwa. That's Wadhwa. And his post is actually called Ditch the Business Plan, Buy a Lottery Ticket, because he's going even farther than I am. He's saying that trying to raise money is crazy. You'd be better off just buying lottery tickets because your time is then freed up to focus on your business. And I agree with that thesis. But he had some statistics that I thought were interesting. They ran a big study of successful companies in high-growth industries. And of course, high-growth industries are where venture capitalists like to invest. So if you're thinking about VC money, it's not going to be easy for you to raise money for like a utility plant or something that's not a growing industry. High growth industries like web business. They found that only 10.8% of these successful companies raised any venture capital at any stage of their growth. So that's, call it 11%. Only 11% of them, these success stories, had ever raised any venture capital. So that means that almost 90% of them never raised any venture capital. Well, that changes the model that the media gives you, right? Doesn't the media make it sound like everybody's raising venture capital all the time? Turns out it's not so. Then, similarly, only 9.2 additional percent received angel financing. Okay, so maybe 10, 11% with VC, another 9 for angel, so call it 20%. Only 20% of successful companies actually raised any venture capital money. But of that, only 4.6% of venture capital went over the last decade to seed stage startups. Now, seed stage is what they call, as you can gather, the early stage, the seed, where it's just brand new. That's the stage where it's usually just you and maybe a partner or two and maybe just a smile and a couple pages of business plan. Only 4.6 of the money, 4.6% of venture capital even went to those kind of businesses. So when you hear these numbers about billions of dollars in venture capital, it's true that most of it goes to second, third, fourth rounds of companies that are well on their way and probably already close to IPO, because that's where the VCs like to invest the most, because they can put more money in and then get a bigger pop for their money with less risk. So the trick is that you actually want to think about your business early on and start small and focus on cash flow. The idea that raising money from third parties is the way to get going, I think, is a mistake and actually kind of a myth. The best thing for you to focus on is your business. Get your business plan together and prove your concept, not by talking about it with your friends and family or getting a couple buddies from college to put in $100 each. Ship some products. Sell some ads. Show that this thing actually works. And if you can get that going, that's when people will come after you and they'll want to invest. If you lead by example, by making money, you won't have any problem raising money. That's the trick in the catch-22. People want to, especially folks who are new to business, they think that somebody else is going to underwrite them, maybe the way the bank underwrote you to buy your first house. And venture capitalists will do that, but it's very rare. 4.6% of the money, and of that, only 20% of the successful companies had ever taken money anyway. So you're talking about a very small slice of the market, and this study doesn't cover it, but I'll bet you that many of those folks were repeat entrepreneurs or had important personal or family connections with the money anyway. So the fact is that venture capital is not the easy way to get going, and you should focus on your business. Build the prototype, ship the product, close some deals, sell some ads, and if that starts working, well, you know what? You might not need investors anyway. And if it does start working and you sold half your company for 50 grand, you're going to be really bummed out anyway. Now, venture capitalists can be very helpful because they have a lot of connections and board seats and advice, but they take a big chunk of the ownership. And I'd rather see you succeed or fail on your own so that you're not beholden to somebody else. Just as I talked about earlier about not getting caught up in legal drama and incorporations and trademark filings and all the administration of your business, a business plan can be the same analysis paralysis challenge. Focus on building the business. Leave the paperwork and the fundraising till later until you're sure that you've got a winner. And if you've got a winner, you may not need the money anyway. I hope that's helpful. I'm Scott Fox. This is the Click Millionaires show at clickmillionaires.tv every Tuesday at 2 p.m. Eastern. And I'm Scott Fox. I've written a couple books about this stuff, and I'd love to see you at scottfox.com too.